Sounds good, Jason. And first off and foremost, thank you all for joining us today.
Oh, 1 minute, almost live.
Okay, sounds good.
Takes a couple. Okay, you're good.
All right, folks, thank you very much for joining us today in the daily webinar presentation. My name is Dean Gallagher. I'm an investment consultant and partner here with Portfolio Builder. My partner Jason and our CEO will be covering everything that we're going to be doing today. And folks, just want to kind of tap on a couple things. And as you can see up on my screen here today, I really think what we do kind of focuses and really kind of mimics the methodology of Warren Buffett's top rules when it comes to investing. Okay, rule number one, never lose money. Rule number two, don't forget rule number one. Okay, and the more I've realized this in my life, the least amount of stress I've had stress levels just kind of wash away, and have really actually started growing my capital at a higher rate, just because of the consistency you get by being defensive. Okay, so I'm gonna go ahead and go to the next slide here. Here's an overview of our daily presentation. So what we're going to overview today. So Jason's going to take over in a minute here. He's going to talk about the trade alert, why we engineered the positioning we did today. He's going to tap on the news, what will drive price action today and tomorrow. And on top of that too, he's also going to tap on to what's going on the financial system, because that is absolutely the biggest driver of price action in the market. Please write down or just unmute your microphone at any point, folks, and ask questions. We will cover a ton of information in a very short period of time. Please don't hesitate to ask questions. They're very helpful to us to deliver the best service possible, really help us understand where the gaps are from what we understand, what you all may not. Okay. There's no such thing as a dumb question. Please feel free to jump in at any time. After Jason goes through that part of the presentation, he's going to pass it back to me. I'll go over the value we provide for our clients. Okay. And one thing too, I want to mention, folks, I'm going to go ahead and just annotate this real quick at the bottom of the webinar. But this is my phone number right here. Okay. Definitely write that phone number down. It's 505-322-7515. Write it down, tape it to your computer, save it in your cell phone. Just save it as Dean or Dean Gallagher, Portfolio Builder, and call me at any time. We can go over your free investment consultation. Absolutely love to do these with our clients. It's a neat way to learn what has been working for folks, what hasn't been working for folks, see where people are underinvested, overinvested, or may have some malinvestments within the market. And just really fun process. I absolutely love to talk about the market and look forward to doing that with each and every one of you. And it's a great added value, during your free trial here. So a couple things real quick I'm going to tap on as well. Just a couple things that you will need to get the most out of our service. Okay. Number one, you're going to need a brokerage account to follow our trading plan that has option trading enabled. Okay, you can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Our minimum allocations is $75,000 for the full system, and that's what I recommend, what I follow. But at the same time, if you don't have that, you only have $35,000, you can also do our light system. Okay, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts released daily at noon Eastern time. Okay, these alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 Eastern Standard Time each day. Okay, you're going to need a mobile phone to receive our text message trade alerts. Many of our clients take these trades on the go from the airport, restaurant, or in the car, anywhere you have service. Folks, and for some reason, if you took the free trial, you didn't enter your cell phone number, email Ryan at portfoliobuilder.io immediately and just tell him, hey, Ryan, I signed up with a landline. Here's my cell phone number. We'll absolutely add you to the text message distribution list. I love the text message alerts. That's how I interact with our program probably 90% of the time. You're going to need an email provider in good working order. Um, and obviously, so you can send out or you can look at the emails we get. We do provide a whole different level of instructions and data that's in the email trade alert. And you also will get your access to the daily presentation from that email. So with that, folks, I want to thank you once again for your time. And I'm going to go ahead and pass it over to Jason and let him start the presentation for today.
Oh, thank you so much for the introduction, Dean.
Thank you, sir.
Looks like we do have 18 live, so thank you all for taking time to join us. We'll follow the outline that Dean gave us. So let's start off by looking at our trade alert. We're winning on 3 out of 4 trades today. The TLT continues to be the stubborn child in our portfolio. But just quickly, let's just outline our portfolio positions that we're currently in. We're very bullish on the SPY. So the current trade that we put on Monday is closing out today with an 85-cent per share profit, or $1,615 from 1,900 shares. Now, we did have to give up about $1 of the run for our downside protection. So our goal is to generate return without being a sitting duck ready to get its head shot off. And so with market at such extreme highs, there's a very high risk of anywhere from a 3 to 10% pullback in stocks. And that would just be from simple profit taking. Now, that's not my call, but I do want to avoid that kind of volatility in our portfolio. So that is why we engineered the trade from Monday through Friday. We'll take a look at that in a moment, how we got in and out of that. Moving along, I do have our P&L on our SPY portfolio. It's been very hot, October, November, December, up 1%, 2%, 1.8%. Now, a lot of those profits have been muted by the pullback in the TLT. However, we'll take a look at that prediction in a little bit. The Tuesday trade for emerging markets is currently up 47 cents a share after having to pay off our in-the-money put option. So we paid a premium of 61 cents for downside protection to be long the very risky but very lucrative emerging markets ETF. So we've been able to show an open profit in this position of 47 cents a share. Now, if you don't have this position yet, you would jump into this next Tuesday. Don't try to jump into the trades until the day of the trade alert. GDX is up 62 cents a share after having to pay down a very expensive put option, $1.15. So we've paid $1 of that off and are still up 62 cents a share. And again, we have twice as many shares of emerging markets, GDX and TLT versus the SPY. So we're up on $2,356 profit on GDX. The TLT we're currently betting down on, and we'll talk a lot about why. My only explanation, typically TLT goes down when SPY is going up. Now we have a very odd thing happening today. SPY is flying higher and TLT is modestly going up in value. And so my expectation is that this is short-lived and just a lot of emerging market debts that are going underwater, specifically bonds in Sweden and other countries that were living in negative yielding bond territory. I think a lot of that capital's fleeing out of these negative yielding bonds and grabbing the only positive yielding debt that's really worthwhile right now, which is US debt. But big picture is that we are expecting the TLT to travel dramatically lower into 2020 and eventually cause stocks to have a sell-off. But I think timing on this could be anywhere from Q3 to Q4 in 2020. So we have quite a rally to take advantage of. Below that in the trade alert, you do get a list of recent SPY trades. And you can see if you have been following the SPY trades, you've done incredibly well. We have every trade alert listed. You can click on the hyperlink and go check it out. So if you want to see the exact trade we put on Monday, you just click on that, and I'll scroll down so we can see how we put it on. Now at the bottom of your trade alert is the detailed step-by-step instructions. And so our trade alert on Monday was one which had very limited downside, but nearly unlimited upside potential. So you could see we get our losses stopped off in this risk graph at around $1, whereas we have unlimited potential to the upside. And that's because we are expecting an almost unbelievable stock rally, which we've been indicating since early October when the phase one trade deal, and said that if the phase one trade deal is signed, that we can go dramatically higher. Okay, so this was the previous week's trade. To get out of last week's trade, you can go to the bottom of the email if you're new to trading options, and we show you visually exactly how to get out of that position. So entering the position, we sold to open the December 20th 322 call. We bought the 321 put. That's your atomic bomb-proof element to the trade alert. If you have that put, you're not going to lose a lot of money no matter what happens, because that put option guarantees you earn $321 per share of SPY, no matter how low the SPY goes, simply because you purchased that downside protection. Now, how did we finance that? We sold the 322 calls. We essentially had a free downside protection with this trade setup. Now, because I think the market could go dramatically higher, and I don't want us to cut off our potential upside, we added in the longer duration, long 323 call option. And so that's how we generated a substantial return today. That's higher than normal for our strategy. So we'll be looking at our normal trades. Just realize because volatility is low and we're in the early stages of a de-escalation in the trade war, that we're expecting a rapid rise in the SPY as people figure out that bond yields are traveling higher as we do quantitative easing. Okay, so that was last week's trade. Let's look at how we get out of that once again. You buy to close your short call position, and then you sell to close your long call. And unfortunately, our put option was only worth a penny, which is actually good. That means we hit a large return, so we can just allow that put option to expire worthless. Now to enter today's trade, per 100 shares of the SPY, we are selling, this covers us until Monday, the December 30th 324 call option. We're buying the 322 put option, and then we're buying the December 31st 324 call option. So we're now up to 20 people live. If anyone has a question, please feel free to use your chat box or hit your raise your hand button so that we can make sure to answer everyone's questions as we're going.
Great.
Now, next in the
options, Jason. Great job.
Okay, great. Now, next thing I do want to pull up is the live risk graph. Let's just see where we're trading at. So we're right about where I put the trade on. So if we do evaluate this trade and what each item means, I think this will add a lot of clarity to everyone who's trying to follow the program. So first of all, it's important to understand what this risk graph is telling you. So the x-axis is kind of like looking on the horizon left to right, and that is showing you the price of the SPY in the future. So if we look to the left, that's if the SPY travels lower. And on this lower bar, you can see that after we get to 322 on the SPY, we magically stop losing money, period, no matter how long the SPY goes. And I used to joke about, being nuclear bomb proof. But the scary thing is that North Korea is back to launching missiles, and they're launching them off the coast of Japan. So unfortunately, this is actually a legitimate fear. But an atomic bomb could literally go off and the SPY could drop 10% over the weekend, just gap open much lower on Monday, it would not matter because you bought the insurance to protect your nest egg. You bought that 322 put. So all you're going to lose is the distance from current price, 323.27, down to 322. Okay, the person who sold that put for 23 cents, he gets to keep your 23 cents, but he has to eat the massive losses that would be ensued if the SPY were to drop, say, 10, 20, 30 bucks because of bad news over the weekend. Okay, so who is actually writing these put options? It's gigantic banks like BlackRock, Vanguard. Okay, so they actually don't mind picking up shares and holding them for a long time, even if it's at a loss, because they make so much money writing these put options underneath every stock and ETF under the sun. Okay, so that is the top and bottom. So if we sell the 324 call, we're collecting 34 cents. That's just about $1 above the current trading price. So if we were assigned and the call option buyer was to exercise his right, he can purchase our shares for a price tag of 324, which is great. That's about $1 profit for us. And we get to keep the 34 cents that he paid for that right, for that option contract. So on that side of the deal, it's not bad at all. Okay, we'll make money if the market goes up. But if it crashes, what's more important is we are protected to the downside. If the market crashes from here, we keep that call option buyer's 34 cents and use it to pay off 100% plus a little extra for that downside protection. So if you're getting a little nervous about how high the SPY has traveled and you think it's due for some simple profit taking, forget about an atomic bomb. Let's just take some profits off the table. This strategy makes a whole lot of sense. Now, we don't want to miss out on big moves to the upside, especially when our forecast is that the SPY could easily climb another 15 to 30% in 2020 before a major event occurs that could cripple stocks into 2021. And we're going to look at that today. But that's why we've purchased the 324 call option for 66 cents per contract times 100, so $66 a contract. And this allows us to not miss out on dramatic upside potential. So if we do look at what happens if the SPY travels higher, you can see that our profits continue to grow side by side with the SPY. So it's a little bit of the best of both worlds. We have very limited downside risk. In fact, we're risking $1.68 per share. So that's about a 0.5% maximum loss in our total portfolio between now and Monday. But on the other side of the coin, we can earn a 0.5% or even more unlimited upside potential simply by using this trade. Now we're up to 20 people live. I see some chats popping in. Let me check this out. Okay, so email guest says, Jason, you buy only one SPY put option because all your clients have a standard 100 shares in the SPY. Yeah, so per 100 shares, a lot of our clients have far more than 100 shares. Many have at least 600 shares. And I'd say the top investors that follow our program probably have between 2,000 and 3,000 shares of the SPY. So you would simply multiply that, the option contracts per 100 shares of the SPY. And you'll find that the more money you have, the more likely you enjoy this program because we're not too worried about trying to pick up profits, speculate, take on risk, hope something happens in the future. Our program is much more defensive and just looking at what are the facts? What are the facts we really have to work with right now? Let's not predict something new is going to happen into the future, but rather let's look at the facts we can trade on right now, today, and going into the future. Okay, so that is that's our current trade. So we are short the 324 call, which means We have to sell our block of 100 shares for 324. The only reason anybody would exercise that right is if the SPY goes way beyond 324. Now, if it does do that, that's okay because we purchased the 324 call option. So we will make money on the SPY appreciating when we sell it at 324. We'll keep that 33 cents. Plus, we'll start to earn profits on the longer duration 324 call option. Now, can we outperform the SPY to the upside? In some instances, yes. But the more likely outcome is that we're going to have tremendous downside protection and generate a great return come Monday if this market prediction is correct and the SPY continues to travel higher. Now let's take a quick break and see if we do have any questions. And I'm going to go ahead and try to unmute everybody and see if we get too much noise. And if not, I might mute everybody back, but you're all unmuted. And I'm going to go ahead and unmute the crowd. Let's make sure we all understand today's trade alert. Okay, any questions?
Jason, is it because of the holiday that it's difficult to get it filled?
Oh, are you having a hard time getting filled today?
I had to go from 54 up to 59 before it filled.
Now, are you trying to exit or enter?
That's to enter today's trade. Getting out of the one we had on Wednesday or on Monday. That one went quickly, but and it was the same thing yesterday.
Limit order, you're definitely going to want to put it out there, wait a few minutes, and then slowly bid higher until you're filled. If you don't want to mess around with that, a market order is a quicker way to get filled. And because, you can look at the spread on each of these trades, 32, 33, 27, 28, 65, 66. That's a super tight market. It's extremely liquid. So you're probably just trying to be a little too cheap on your bid. I bet if you're just a penny or two higher, you get filled real quick.
Yeah, and William, I always just use market in, market out. These SPY positions are so liquid. I just use market. It's, I mean, you can mess around with it, try to catch a little run in 5 minutes or something, but that's something I did when I first started. Market in, market out's the easiest way to go. And back to my day.
Market in, market out. So that's something that's down Thinkorswim.
Oh yeah, just instead of doing the limit order, just do the market order.
Okay.
And it'll feel a little bit easier.
Okay.
Someone asked, why sell your December 30th 323 call? Well, so when we bought that call option, the SPY was much lower, so it appreciated dramatically. And so we're going to always be exiting the entire position and entering an entirely new position. This makes it very easy for new people following the program to have the exact results of our program. Now imagine I didn't close at that 323 call and held on to it until, well, the markets closed Wednesday. But now I'd have half my group with a couple call options, and then the other half coming in that are newcomers wouldn't have that position. And so this is actually a problem that most advisories have, is that they want to build these portfolios at a single point in time, and it may make sense at that single point in time. But the problem is they're constantly adding new subscribers to their service. And for new folks coming in, this is very confusing. What trade should I put on and what should I not? And as a publisher, you now have this nightmare of trying to design new, now they'll say, okay, this position's a hold, this one's a buy, this one's too late, don't follow it. So now you're joining in, you don't have the same risk profile that they initially had. It's a complete mess. So that's really one of the most beautiful things about this program, is that every trade is what I call self-destruct. We're going to completely exit and re-enter that position every trading period. And by doing so, this solves probably the biggest single problem for Trade Alert advisory services, is that nobody gets the result of the guru. In our program, whether we're winning or losing, I got plenty of our customers here live that can testify to this. Whether it's good or bad, we're getting the exact same results within pennies. And it's because of the design of the trade alerts. So every position will be completely entered and exited in each trade alert. And this ensures that all of our members get the same results. So by placing the trade at the same time each day on a set schedule with a very strict capital allocation and trading plan, it makes it easy for you to know what we're trading when, how much of your assets you should have in each ETF, and exactly which option contracts to help enhance your returns. And yes, for the email guests asking if this is recorded, just go back to the email later today that brought you to this live webinar, click that same link, and it will automatically replay today's presentation.
Great, great. Can you? Hello, can you hear me?
Go ahead. Any other questions?
Can you hear me properly? Because I'm just using an iPad. I can hear you well, but I'm not sure if you can hear me well.
Yes, I can.
Oh, great. I was wondering if you could send me an email listing out your light portfolio, what must be in it, by when, etc. If I decide to join, and I would actually understand what you're doing more if I actually pretend that I was, trying out the light portfolio.
Yeah, so I think with the light portfolio, you really have two good options. If you have at least $30,000, you can trade the SPY Monday, Wednesday,
Right.
Friday, and a lot of people really enjoy that. In fact, our program started with people just trading the SPY, and
Right.
so that might be a great option for you, and that's our light program. Or alternatively, with $30,000, you could also do our Tuesday, Thursday combination, which is unique because now you have emerging markets and bonds in your portfolio and you trade twice a week. So either solution is great.
Right.
Depending on that. Now we do
send me an email.
Yeah, let us know what your email address is, or private message. Dean could probably private message you.
Yeah, and guest, I'm sorry, what was your name? What was your first name?
David.
David, yeah, I just sent you a private message asking for your email address. So just respond to that private message, and I'll be more than happy
Okay.
to send that info over to you. Okay.
All right.
Okay,
Thank
guys,
you.
we've got a lot of new people joining in. We're up to 22 live. Thank you so much. I do want to remind you that if you go back to your email in a couple hours, you can certainly replay this by clicking the same link that gave you the live access. This is very good to trade with a cash account or an IRA account. This is great to trade in any account that you don't want to lose value and want to safely grow either income or your total account size. So yeah, certainly because of the speed of the trades and all the capital gains, an IRA does have some advantages. A lot of 401ks won't have access to these products, but IRAs do. So if you can roll it out of a 401k and jump it into an IRA and get it over to Ameritrade, then you're really going to be set. And yeah, some 401k, the 401ks are kind of a mixed bag if you'll have these products, but certainly it's a good strategy. I've got my 11-year-old following it. So it's just if you understand the risks in the market, then suddenly this becomes extremely attractive. And it's hard to feel like there's any risk in the market when we're having the best returns since 1997. Funny, we have to go back almost 22 years to have a stock return of this magnitude. So if you feel like you've had a good run and all of a sudden you're a little worried that there's some downside risks and you want to control your return instead of just kind of hope for the best, pull the Clint Eastwood, you feeling lucky? That's really where this strategy plays a lot of value. Sure, but at Ameritrade, you have super cheap commissions on all this. So the commission costs are relatively low. Okay, any other questions out there before we continue? I do have a lot of good content for you guys today. Mainly, why on earth do we think stocks will keep going up after they just had the best year since 1997? That's a good question. Why on earth would that continue? And what are the big risks? What could cause the end of this massive stock rally? Any questions out there before we continue? Okay, great. I'm gonna go ahead and mute everyone back up, and then I'll unmute you after we go through the news and charts. And then after that, I do have a final PowerPoint that really goes over our strategy. So, okay. Okay, so now what I have up is the key news. Today I've organized it US business news first, news about China relative to the trade war and their slowing growth second, which is critical to all of these predictions. Third, political news, mainly Bernie going to take over the driving stick here and ruin the stock and bond market, or is it going to be another 4 years of Trump? The key things I'm looking at with that. And then finally, a whole bunch of charts. So we'll look at stocks, bonds, commodities, currencies, the works. After that, we've got a video of the yield curve, which probably sounds foreign to all of you, but you'll see the value of studying the yield curve, and then a quick PowerPoint that really shows the big picture and my market forecast for the next 3 to 4 years. Okay, so the main thing that I study are central banks and their policies. And what we've come to find, especially in the last decade, is that the central banks are primarily the biggest market movers. And so if we can predict the actions of the Fed and other central banks, we can have a pretty good idea of what's going to happen to the macro picture. So we can figure out what's going to happen to stocks, what's going to happen to bonds. And from that, we can articulate what should happen to emerging markets, just a riskier version of the SPY. And then finally, what's going to happen with gold, which is something I love to play either direction. So I'm no gold bug, although I do believe that has the longest run before the eventual reset for all of these assets. So we'll take a look at that. Key thing is the Fed has grown the balance sheet by $400 billion since September. And I want you to remember that September, when we look at the yield curve video, you'll see something dramatically changed in the bond market on September and leading up to September. So that's going to be critical for predicting these markets. But if you're wondering why stocks are soaring higher, blowing past reasonable PE multiples, earnings are on the decline, what on earth is going on? Well, there you go. The Fed is pumping $100 billion into the banks every month. And so if you're not familiar with how this works, mainly it's JP Morgan, primary dealer, buys the treasuries from the government, which are at a record pace, 2.55 trillion treasuries to be sold in the next 12 months. And we've only collected or expect to collect 1.5 trillion in tax receipts. So that leaves the US government short $1 trillion. So believe it or not, the US government's deficit is what's forcing the stock market to go up. Weird. The government is creating more debt than it can collect from its citizens and companies, which should be a bad thing. But because the Fed is buying up that debt and putting it in its balance sheet, that's freeing up JP Morgan to be in cash. What do they do with that cash? They lend it out to hedge funds who leverage up. Okay, so that's your bottom line there. The good news is they're pretty pretty good at giving us an idea of how long they're going to continue increasing their balance sheet. Now, the more you can predict this before it happens, obviously, the more money there is to be made. But I suspect this will not end anytime soon. As long as the US government is creating massive deficits, the banks are just out of money. They're flat out of money. So they have to sell these to the Fed. And the Fed's doing a combination of repo, which is kind of more like, hey, we'll hold those for you and give you cash for a while. Plus, they're also straight up purchasing bonds for forever. So those bonds are gone and they will live there in the Fed's balance sheet forever. So this is the single most important thing to watch. The other thing is whether the Fed is increasing, decreasing, or leaving rates flat. Right now, they're leaving rates flat, and they probably will for most of 2020. So this is why we're really negative on bonds, as money's just going to pile into stocks and put a lot of pressure on the bond market. So we'll take a look at that in a moment, but that's your key figure. They update this every Thursday, so they just updated it last night. And of course, it continues to scream higher. And it's even funny, the very few times that the Fed's balance sheet does pull back. So look at that little dip in November. Well, lo and behold, the only negative week for the SPY in the last 3 months coincides exactly with the reduction in the balance sheet. So if you don't think the Fed is the single most important player in the markets, well, there's your proof. Here's a look at the stock return. And I think with today's push up and probably to close out the year, we can beat that 1997 record return. Now, a lot of people are like, wow, if this is just like 1997, can we correlate 98, 99 to say we got 2 more years of runway on stocks? Well, we'll look at that in a little while. 2019's undisputed man of the year, Jamie Dimon, for successfully forcing the Fed to launch QE4 after sparking a repo market crisis when JP Morgan withdrew $200 billion in liquidity from repo markets. So repo is not the same thing as quantitative easing. Quantitative easing is when the Fed buys the bonds permanently, and repo essentially allows JP Morgan to lend their treasuries to the Fed for cash. And what do they do with that cash? They lend it to broker dealers who turn around and lend it to hedge fund managers who leverage up into a stock bond strategy. And so that's what caused the repo madness. We'll take a look at the yield curve to have a little more insight into this. But the bottom line is, as long as the US government continues pumping out $100 billion of treasuries that they need to sell, this trend will not stop. And the US government is on track to continue this trend for the next decade. So it's going to be interesting to see how the Fed continues to deal with more and more debt that it cannot service from tax receipts. And so this is the upside down world we live in when we have the central bank trying to protect the bond market and allow such malinvestment to continue. 6 asset managers control 92% of all ETF assets. The other 118 of them are fighting over 8% of assets. The top 2, BlackRock and Vanguard, manage 2 out of every 3 ETF dollars in the US. Fascinating. It just goes to show how the top players, no matter which industry you're in, continue to gobble up their competition and monopolize their markets. Look at Apple, look at Amazon, look at Google, look at BlackRock and Vanguard. Everybody keeps talking about an economic rebound, and a lot of that expectation is based on Chinese pitching in with stimulus. Why doesn't anyone actually listen to what the Chinese are saying? Simply because it's not what they want to hear. So China's talking more about a managed decline and less so stimulus. However, there is some good news. They are in the process of laying out trillion-dollar plans to begin their Belt and Road Initiative. And this is exactly what we do want to see to be long emerging markets. If you remember 2018, which we're going to look at in detail in a little bit, emerging markets were headed down for all of 2018 while US was headed up. So currently we're long emerging markets and the US. And that's because we have not only the Fed, but the Bank of Japan and the ECB doing quantitative easing. So the only one not was China. Now, just until recently, we've seen them start to expand their debt. Okay, Hong Kong is critical for China to raise capital, and it's critical for emerging markets. But meanwhile, the protests do not slow down, and they've canceled New Year's plans. This is a critical piece of news to follow. If Hong Kong goes down, there could be some severe consequences to China. We're seeing China start to make moves to try to move its financial district to Macau, which is currently their version of Las Vegas. Now, also, Hong Kong is home of the most expensive real estate in the entire world. There's nothing that even comes close. So this could create an avalanche of problems if, one, their currency peg breaks, which is pegged to the dollar. They have 1.4 trillion Hong Kong dollars in circulation, but they only have a $400 billion reserve of US dollars. So if real estate prices start to sell off and people try to get out of the Hong Kong dollar, this could be disastrous for both US, Hong Kong, and China. So this is something I pay close attention to. Also, this entire prediction that stocks can go up another 15 to 30% into 2020 relies on China living up to its most recent promise to purchase agricultural products. Now, if you've been following me, I've been skeptical that the Chinese would want to do anything that would help Trump since July. And we've been playing the markets very conservatively, expecting that there was a high risk of a trade war escalation. And so far, it looks like the Democrats have gotten so nasty about China, especially in the last month, that I think they now realize that trying to get a Democrat into the presidency may not, A, be possible, or B, be advantageous, especially with Joe Biden or Bloomberg, who are the two in their pocket, most likely have no chance whatsoever. So we'll take a look at the political news in a little bit, but you can see China imports of soybeans are ramping up. So that's good news if you want to be long emerging markets as well as the SPY. China food inflation. This has caused riots and revolutions in many countries in the past, including in China, especially the Tiananmen Square was mainly due to inflation. A lot of college kids got pissed off, thought they were brave, protested for several months until they massacred many, many Chinese. Now, the world's been quiet about it. This entire event is blacklisted in China. And if you are a partner of China, if you even say that word, that's a big no-no. So to see this food inflation is a very high concern for China. And if you understand what central banks typically do to countermeasure inflation, it involves hiking interest rates, which would be very disastrous for China's stock market, as well as for their bond market. So this is something I'm paying close attention to. Perhaps the food inflation is self-inflicted from the trade war and can be resolved with this phase one trade deal. So I definitely want to see that food inflation start to wind back down. Because imagine you're making $11,000 a year in China, you're paying a 70% tax rate, and your food prices are skyrocketing. That's not going to make people happy. Okay, this is a Twitter handle from China. Congrats to U.S. farmers. Meanwhile, please prod the U.S. government, making sure the two countries can sign phase one deals smoothly and the next trade talks continue to make progress. This is vital to stabilize China's purchase of US farm products. So definitely critical to keep a close eye on anything going negative in that realm. Now we're looking at some of the political news. Rudy Giuliani: removing a president less than a year before an election must only occur if his remaining in office irreparably damages the nation. Well, the Pelosi 2-week vacation proves this is an unlawful co-op and partisan political purposes. The taxpayer should not have to pay. Now this is interesting. This is a guy named Kim.com. He was one of the first people creating these free hosting websites, made a ton of money, but it was all pirated content, ended up losing all his assets. It's become a popular figure in the crypto world. And I only brought it up because this is a bigger problem that could be facing US tech companies in the next several years. And that is censorship. And so the news hitting was that YouTube is cutting off crypto content creators. The US government is behind this. The war against crypto has begun. US empire won't allow anything to undermine its control of the financial system. Okay, so if we do see that we're dramatically devaluing the dollar because of this massive surplus of government debt, and it's just being added to the balance sheet, that's a very negative for the dollar. And maybe why the Facebook's Libra project has been put on hold. The dollar's really critical for US to be able to create so much debt and continue its lifestyle. Next tweet from Kim.com: YouTube is now reinstating the videos of crypto influencers. This wasn't an accident. YouTube and Google are in bed with the deep state. This attempt to silence the crypto community has failed. So we've seen Google silencing people. We've seen Twitter doing the same, Facebook. So the only reason I bring this up is if we see this continue to happen, there's a risk that some of these tech companies could be under some pressure, like we saw with Microsoft having a monopoly. A little bit different though. So this has actually been in Congress all year and continues to be something to worry about. Okay, from Trump: why should crazy Nancy Pelosi, just because she has a slight majority in the House, be allowed to impeach the President of the United States? They got 0 Republican votes. There was no crime. The call with Ukraine was perfect with no pressure. She said it must be bipartisan. So I'm curious if this is going to, what on earth's happening with this? We were expecting to see it begin in early January. Then Mitch McConnell was saying they were just going to do a super fast 10-day trial with no witnesses. And that's why Pelosi has not passed this to continue the trial. So we're watching that closely to see what's going to happen with this. Is it going to get delayed? And mainly they want Bolton to come up as a testimony, which could be a wild card in the impeachment trial. Meanwhile, Bernie might be the nominee for the Democrats. Didn't see that coming, but he continues to pull at second place after Elizabeth Warren has tanked. Joe Biden still pulls as number 1, but the poor guy has a hard time speaking in front of crowds. If you've watched the last few debates, he has a hard time really just clearly articulating himself. So I don't think he's going to have a chance, especially if there are witnesses in the impeachment trial. Of course, he and his son will be put up on the stage, and I don't think that's going to bode well on public TV. So is Bernie going to really have his chance? We'll see. They definitely cut him out of the race against Hillary when he was dominating last time around. He survived this heart attack. He's been really true to his word for a considerable amount of time. Who would have guessed Bernie has a good chance coming in? In terms of what I'm really worried about is if we do start to get a lot of socialist policy in the US, this would most likely implode both the stock and bond market. So that's still a ways out, but keeping a close eye. Meanwhile, the billionaires are spending massive amounts of money. Tom Steyer and Bloomberg, and their polling is extremely low right now. So if they do start to pick up in the polls, we'll cover more of their content But so far, looks like Joe and Bernie are holding the lead. Okay, now we're looking at charts. Here's your SPY ETF. It's just been a massive rally since the 2008 crisis. We've had QE1, QE2, Operation Twist, QE3. Then we had a good pause. 2018, they tried to do quantitative tightening and raise interest rates. We got a stock crash right at the end of the year. And then what happened? They went right back to QE4. So they started off with some rate cuts for 3 rate cuts in 2019. And to close out the year and go into 2020, we're doing quantitative easing. And so there's been some pretty easy to predict trends over this period. Whenever they do QE, which is when they purchase bonds, we're seeing stocks go up and the value of bonds go down. Whenever they cut rates is when we see the value of bonds go up, and this is usually in the face of stocks going down. So we're doing QE and we're not cutting rates. That means you want to be betting up on stocks and down on bonds. That's really as simple as it is. Here's a look at the TLT. You can see it's already started to tank. My expectation is it will sell off for the bulk of 2020. Now, the trade alert we put on yesterday is underwater, but we've got a long time until next Thursday, and we'll be placing this trade over and over and over again until we reach a critical level in the bond market that should attract a lot of things. Number one, money to flow out of stocks into high-yielding bonds, and two, cause a stock crash that gives the Fed ammunition to cut rates even lower, which will allow companies like JP Morgan to unload these massive bond positions that they've accumulated for huge profits and not have to sell it in the open market. It's important that they can guarantee a profit and unload a massive position, because if they were to just try to unload this right now in the open market, TLT would tank and they would probably lose a lot of money. So unless you think JP Morgan is going to take a massive loss on its bond position, which is up 50% in 2019, this really has to happen. And the Fed needs cover to make the next rate cuts and then go into real QE. We'll talk about why the Fed's calling what they're currently doing not QE, although it does have the same effect. Okay, here's a look at the TLT just in the last month. You can see it's began selling off. A little bit of a bounce today. And I think this is simply from debt globally that was at a very low or even negative yielding debt or yield, realizing that this is the big trend and they have to reallocate to something with positive yielding bonds, which is really the best bet's your US Treasuries. So we're getting a little bounce, but I do suspect this has tremendous downward pressure until it gets towards the, if we go back to this chart, I don't think it'll get as low as it was in 2019. You got to remember, to get that low with this amount of debt that's been leveraged into the banks, they had to actually hike interest rates and do quantitative tightening. So I don't think we'll get anywhere near that 115 level before it creates turmoil in stocks. So my target is around 120 to 125 before I'm going to get very nervous about stocks and very bullish on bonds, with the expectation that the Fed must control the situation, save the stock market, cut rates to zero, and let JP Morgan unload this massive, massive bond position they've accumulated. Okay, emerging markets. This is mainly China and India and Russia and all the countries that do business with China. It's been a tough bet. A lot of big money has been playing this with no luck for quite some time, but it's just trading at such a cheap valuation. Its PE levels are several multiples below the SPY, and this part of the world in Asia services 2/3 of the population. Their companies are growing at massive pace, and they have state subsidies from China. So they have a lot of advantages when the world's not punishing them, but they have a lot of disadvantages when the world pulls the credit. So if we have positive environment with US-China relations and China is spending money, I want to be bullish on emerging markets, which is currently where we're at, and we're up on that position. GDX is your gold miners. If the price of spot gold is above 1,500 and stays at that level because central banks are increasing the money supply. So think about it. If gold stays static, they can only mine so much. In fact, they can mine gold at a much slower pace than central banks can print money. They don't even print money anymore. They type money. So the money supply is growing much faster than the amount of gold being dug up out of the ground. And so when you understand that, and you understand that they most likely will continue printing money to service big deficits. We're seeing fiscal spending in all of the major countries. Well, then the value of gold must go higher. So we want to invest in the gold miners. And that's why we're long GDX. Last time we had some pretty heavy QE was 2009, 2010. And that pushed GDX to 66. And that was from a much smaller crisis in the US housing. This time around, it's more like $1 trillion loss or more being covered up in China that they're trying to soft land. And so as this debt is put into the books, they're going to have to continue printing more and more money to save themselves from a major recession or even a depression. So the big picture is we can predict that there will be a lot of QE for the next several years. I think we're going to have this not QE for 2020. Then we cut rates to zero and then do real QE in 2021. And they'll use the excuse of continued trade war after the election. So that's really what I think we're going to see. Now, in those conditions, we should be able to get a decent run up in gold in 2020, but I don't think you're going to see the real fireworks till 2021, 2022. And again, I do suspect this will blow past the high we saw in 2012. Okay, moving along. Now, what else could stop the stock market? Well, what's actually making the stock market go higher? It's not retail investors. They've been selling all year. Hedge funds have not done well. There's not been many people doing well this year, despite the market rally. It's really these passive investors who never look at their portfolio who've done well. But anyone who's an active trader has had a tough time. And this includes legendary hedge fund traders like Ray Dalio, Jeffrey Gundlach, Stanley Druckenmiller. So what could cause the stock market to stop rallying at such record pace? What's actually making it go up? Well, the answer is corporate buybacks. Those are actually the main source of money that's been flowing into the stock market, about $5 trillion in the last decade. And the good news, if you want to be long stocks, is this chart right here is an easy way to tell what the cost of credit is for your Apple, your Amazon, your Microsoft. The higher LQD goes, the cheaper corporations have access to credit by selling bonds, which they turn around and buy their own stock back. So for us to want to bet down on stocks for more than a couple months, I would want to see LQD tanking and staying down. And that would mean that no longer can a corporation borrow money. In fact, Microsoft's getting negative yielding debt in Europe. That means they're getting paid to lend, to borrow, and buy back their own stock. Who wouldn't take a negative yielding bond? It's absolute insanity, but that's the world we're in right now. And so as long as this LQD is up at a high level, the SPY is relatively safe. So this is probably our best, most accurate way to predict a long-term downturn in stocks. So that is something I constantly watch. And really, it's amazing that it is still remaining at this high level. Okay, now your junk bond ETF, HYG, is also in an uptrend currently, but it's not anywhere near its all-time high. So we're once again seeing this world that's polarized, where your big conglomerate leaders get a better deal, they get cheaper credit, they can simply buy off all their competitors and continue to monopolize their market, whereas everyone else has to pay more for loans, work harder, and have less advantages. So this is very correlated to your Russell 2000. And at this point, we have both junk bond and investment grade bonds at very low rates, which means the entire market can rally up together currently. EMB is emerging market debt, and I suspect that some of the lower quality debt that's facing rising rates will be the first to crash. So I'm starting to expand the ETFs I look at to look at some other bond markets, which I suspect are going to start rolling out of low grade, low yielding debt into better quality, higher yielding debt. And I think that's why we see a little bit of a bounce in the TLT today, is that people that were sitting on risky bonds that generate a yield lower than inflation are starting to run for the exit. So EMB is primarily a bunch of little countries doing business with China. So far, no crash in that bond market. iGov gives you a lot of the European bonds, which were primarily in negative territory, and we are seeing that sell off. So that could be rotating into US Treasuries currently. BWX is your China, Indonesia, Korean. And if there's massive inflation in China, they're going to have to at least keep rates flat. And if it gets out of control, they will certainly raise interest rates. And so that could create a domino effect in credit markets. So currently, these are the top 5 bond funds I'm watching. If any one of these starts to sell off, that is a warning sign for credit markets. And so far, the only one showing any signs of a sell-off is that European debt, which has been in the negative yielding territory. Okay, so moving along, here's your look at gold. Jumped above 1,500. Now, again, we like to own the gold miners versus spot gold, a lot more potential profit. It's riskier, that's why we buy that put below to protect the position. Crude oil is heating up, and it is at, I think it's about 67 today. So what does that mean? Growth is hot, it's great for stocks, but what does that mean? Inflation. A lot of products are created with oil, so if oil prices are going up, that creates inflationary pressures. Another reason why we want to be short the bond market at this point in time. Okay, silver shot up. This is just a risky version of gold, but I do like to see silver jumping up to give me the courage to be a little more bullish on our GDX position. So we'll see, can it break past this 18 or will it sell back to that 16 level? Next, I'm looking at the dollar. So if the dollar is gaining in value, that's very bad for the rest of the world. Makes their debts, which are all denominated in dollars, more expensive to service. And it's also negative for our emerging markets position. So if we do want to be betting big on emerging markets, this is something we can keep a close eye on. So US against the euro has been weakening. It's starting to stabilize and go flat, so that's a good sign for the rest of the world, that is. The yen against the dollar has been, over the last 5 years, has really strengthened, but it's been weakening in 2019, and that is starting to flatten. The USD against the offshore yuan, China's currency, has been strengthening in China's favor. So this is, again, very bullish for stocks, including emerging markets. Now in our boot camp, this is one of our favorite trades we've been patiently waiting for. Unfortunately, it looks like we'll probably want to jump into this right before the election in November of 2020, as I do anticipate that we'll need a new crisis to get our rates lower. And what perfect excuse other than to create more trade tensions with China. The Hong Kong dollar has strengthened, also bullish for stocks, but we're seeing the protests are not coming to an end. So if we start to see the real estate market get into some turmoil and these protests continue into 2020, we might potentially look at having a short position on the Hong Kong dollar. And again, this would be part of our boot camp program. Now we had Brexit, so UK has left Euro. This is actually Stanley Druckenmiller's one of his core positions for 2020, and that's to be short the yen and long the pound. In our boot camp, we're long 2 banks that would take advantage of this that are doing very well. And we're also long 2 copper stocks that are also doing very well since we entered that position. Also, another metric relative to China is Australia. So if we can see the Australian dollar strengthening, that's also a good sign for emerging markets. So it's starting to, it's been weakening in 2019 after being a little bit stronger. So keeping a close eye on that. Another trade that Stanley Druckenmiller put out was to be long the Mexican peso. So this ties into the USMCA deal and also a weakening dollar from massive expansion of the central bank balance sheet. Now, one of our copper plays is based in Mexico, so we have exposure to this trade without having to do the currency play. Meanwhile, the single chart to show you the health of the dollar is in the DXY. And so we're seeing it starting to turn over and not go above that 100 level. If we see it jump up above 100, this most likely will start off with emerging markets selling off and causing a lot of turmoil globally. So that's why we look at the currency pairs. The best forward-looking indicator for US Treasuries is looking at the German 30-year bond. And you can see it's going straight up most recently. And I think this trend can continue until these yields get too attractive. And as long as the trade war with China is in a phase of de-escalating. So this is our best leading indicator for that. And we're seeing a little bit of a different most recent move. You can see the 30-year US yield has gone down while the 30-year German bond has gone up. And I think we're just seeing some money get out of low yielding debts and flying over out of Europe into US debts where they can at least get a positive yield. But my expectation is as long as the trade war is de-escalating, the US government's creating about $100 billion of debt that they can't service from tax receipts per month, that the overall pressure will be higher yields. So that means stock market is going up and bond market's going down. Now I'm just curious, a lot of people like to look at crypto as a genuine look at what's happening with central bank policy. If central banks are being reckless and devaluing their currency, then cryptocurrencies should find a way to thrive. And so they continue to hold on to these decent levels. Now we have seen Bitcoin and Ethereum have a huge rally early in 2019, which benefited our portfolio. We have a tiny 1% position in Bitcoin and Ethereum. So currently that's down a little bit, but this is probably a great buying opportunity, despite seeing some moves from China and the US now that they're starting to get concerned about cracking down on capital outflows into these products. Okay, so that's a wrap of that. What I want to do now is look at the yield curve, and then we'll go back open for Q&A. We've still got 19 people live. Thank you for joining us. I think a few new people. Actually, I'll unmute it now for a quick break.
Jump right back on the mic. So we founded S&P Capital in 2006, and the goal.
Okay, so let's see. Does anyone have a question at this point before we go into the next part of our presentation?
Matt.
All right, guys, any questions out there? YouTube guest, William, Scotty, Ronald Steger, Ronald Brooks. We got about 12 or so email guests. Ed Danzo, Charles Barafaresia, Lavinius Daniel, Invesco. Any questions at all, folks? Please feel free to unmute your mic and jump in.
All right, well, no worries. If you come up with a question, feel free to post in the chat box. I will mute us all for a moment. and continue. Okay, so what I have here is a little video I recorded to show you the yield curve. So real quick, what's the yield curve? On the bottom, on the x-axis, so looking left to right, horizontally, we have the 1 month, 3 month, 1 year. Those are your T-bills. That's the front end of the yield curve. That's currently what the Fed is purchasing. And because that debt rolls off so quickly, they say this is not QE. So $400 billion of not QE has been completely isolated into the front end of the yield curve since September. So remember that date, September. We talked about this early. We got to remember that date because you're going to see what happened. Okay, now next we have the notes, the 2-year, 3-year, 5-year, 7-year, 10-year notes. Okay, that's the middle of your yield curve. And then finally, we have the bonds, the 20-year, 30-year bonds. So the TLT is playing the 20-year, 30-year bonds. And because they essentially have 20 and 30 years into that duration, it's something like having 20 times the leverage of playing the 1-year bond. So that's why the TLT is so popular. Just small changes in interest rate can make the TLT go up or down dramatically in value. Okay, so that's what we have on the x-axis. On the y-axis, looking up and down vertically, we have the yield. Higher the yield, the lower the bond price. So you have to look at it from two perspectives. Are we buying the bond because we want to make 3% a year for 10 or 20 years? Okay, that's great. Or are we buying it because we want to speculate that the yield will go down? If the yield goes down from where you purchased the bond, you can flip the bond for a profit. Okay, now on the other hand, if I buy a bond at a low yield and then those rates go up, I better be happy with that low yield, because if I want to get out of that bond, I'm losing a lot of money. And so that's what I believe is happening in Europe and will continue to exacerbate, is that their yields are rising and a massive amount of money was put into them at a yield that's not worth holding. In fact, the inflation rate's higher than the yield, and in some cases, the yield's negative. So you're guaranteed to lose that negative yield year after year until the duration of the bond, or you exit the bond for a big loss. So those are the key things to remember when we play this short little video. So I'm going to go ahead and play. Okay, so we're going back to 2018, and I'm starting to put up the yield curve every couple months. Now, the blue line is where we're at today. So just remember that's where the yields have ended up. Okay, but now we're seeing what happened in 2018, which was a bull market until it wasn't. Okay, so we're watching those yields go up. Now we're adding August. That 10-year is at 2.95. Now we're adding in October. Now what happened right after October? Stock market began to sell off. And by December we had the vicious Christmas massacre, which could have wrecked portfolios, could have been the next 2008 crisis, but lo and behold, Fed came in, saved the day, and pumped the market up all of 2019. So for buy and hold investors, thank goodness. Otherwise, they'd be sitting on massive losses. But what happened when this treasury hit 3% on the 10-year and 3.3 on the 20-year? Well, let's think about it. Stocks have gone up all year. And all of a sudden, you have to decide, do I think stocks will continue going up in the face of interest rates headed higher, which is what the Fed was saying they're going to do, and quantitative tightening? Or is it a better investment to grab the 20-year treasury at 3.3? Well, if inflation targets 2% and I can get a guaranteed return of 3.3% per year, I have essentially a guaranteed profit at no risk for 10, 20, 30 years. I'm going to leverage into that trade and make a lot of money, especially when I realize this is exactly what all the other banks are going to think. And not only do they feel safe with that yield for the full 20 years, they also realize one other thing. This is going to cause stocks to crash and force the Fed to lower interest rates. And if they lower interest rates, that drags these yields dramatically down artificially. And if those yields are going down, I have the best of both worlds. I have 20-year guaranteed profit that's higher than inflation. Plus, I have the opportunity, the chance, the possibility that the Fed wants to control the credit market, lower rates, and now I can fling these bonds for a big profit. So let's see what happened. Oh, it didn't last long. Money flew into those bonds so fast. Stocks are tanking during this period. By 2019, the Fed has to take action. So all the banks knew exactly what would happen. Yield curves inverted. Front end of the yield curve is paying a higher yield than the middle. And we're about to get towards that infamous meeting. It was actually a webinar, not even a real meeting. Look how inverted that yield curve is. And then we get to September. Pause it. So come September, they knew they had to fix this yield curve. They cut rates that lowered the majority of the more valuable bonds. So the 2-year, 3-year, 5-year, you can see all those bonds that have leverage because of their duration are dropping lower. But the front end was not believing it and still demanding these 2% yields. And so what happened next? This is when QE light, we could call it, began. And so what did they do? They bought the front end of the Treasury curve aggressively. And they've been doing it to the tune of $100 billion a month for the last 4 months. They've increased the balance sheet by $400 billion. And they've done it by artificially pushing the yields on the front end of the yield curve dramatically down. Now, is the long end believing it? No. It's almost like a kite. We've got the Fed, it's holding the string down here, but the rest of the bonds want to rise. And so that's what I suspect will happen until the Fed comes in and cuts rates, is that they can maintain somewhat of a stabilization on the front end so that our yield curve looks straight, which is important for banks. They borrow at a cheaper rate and lend at a more expensive rate, and that's how they generate profits. So anytime the yield curve inverts, it messes up their entire business model. But my expectation is they can keep control of that front end of the curve with not QE, but the portion of the curve they're not purchasing will rise. And so that's our big play on the TLT. Okay, so let me jump into our slideshow, and then we can go into Q&A and put the screen back on Dean. Here's our disclaimer. If you want to pause it, come back, you can read that. Okay, guys, the easy way to predict markets and generate safe income. Daily income trade alerts at noon Eastern. To review, our trade allocation per $75,000 is 100 shares of the SPY traded Monday, Wednesday, Friday, 200 shares of emerging markets on Tuesday, and then 200 shares of TLT and GDX on Thursday. Our target income is a 1% return per month, and we've averaged 1.18% per month. We've had profits in 11 of the past 13 months. The largest drawdown our members have seen in a full month is -1%. We broke even 1 month. Never lost capital over a 90-day period. And as you can see, we really do well when stocks sell off. At least that's the case when we're long the TLT. Right now, we're not long the TLT. So we have gone over why I believe the bond market has rallied far ahead of itself and needs to balance itself back towards higher yielding bonds. You can see we've performed well in all market environments, going up, down, flat, sideways. And that's because of our ability to look at the big picture and design safe trades that take advantage of the macro picture. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Our goal is to generate income and safety, not growth or speculation. This allows you to simplify your holdings, reduce your risk, get better results with less work, and weather-proof your retirement portfolio. So here's my market predictions looking several years into the future. At this point, it does seem clear that we will have a de-escalating trade war. And this is after being in a position where the trade war was escalating. So the short-term reaction on this is for, and this is again with low interest rates, 1.75, low inflation, and we're doing QE light. So we're long the stocks and gold stocks and short the bond market. Okay, and this is until rising bond yields and the fake QE creates a mini stock crash. And again, I think this will be a short-lived stock crash because the Fed still has some ammunition. So once we see that 10-year treasury get around 2.8, expect to flip our trades exactly the opposite as we have now. So we'll do the inverted option collar on the SPY emerging markets and remain long on the TLT and still long gold. Now, with the expectation that the Fed will fix this by rates dropping and a new China conflict, we eventually get a bounce in stocks. We stop the rise of yields in the TLT and then enter into 2021. And this is where I do expect that the US and China will re-engage in trade war. So we'd be back to short stocks, long bonds and gold. And this will turn into real QE. So instead of buying the front end of the treasury, the Fed cuts rates to 0 and then moves into purchasing the middle and long end of the treasury, which will be extremely bullish for stocks, probably the last final hurrah for stocks, negative for bonds. And this is where I think we really get the big push in gold. And finally, you do this long enough, you have rising inflation, which forces the Fed to raise interest rates. And this is the big reset America needs. This is how we keep the dollar, the world's reserve currency. We don't go to a gold reserve. And this is what will sell off all assets worldwide and where you really need that inverted option collar. Exactly when the Fed wants to raise interest rates and gets worried about inflation, we'll have to watch and see. But that's really what I believe will stop the final stock rally, which will occur after we escalate with China in 2021, drop rates to 0, and do the real QE. Okay, again, to reiterate the 3 strategies, we have the bullish loose option collar. This is our go-to strategy if we think the asset goes up. It protects us against downside risk in case we're wrong, but allows us to generate a large profit to the upside. This is our neutral tight option collar. If we think we're near a top and there's a high risk of a sell-off, then we want to have this tight option collar. So this will probably be a good trade for us as we get closer to the election in stocks. And then we have the bearish inverted option collar where we sell the in-the-money call by the in-the-money put. And it's a very clever, safe way to bet down on an asset. So this is where we're at on the TLT currently. There's one last round of ammunition for the Fed. So I don't think this business cycle will end in 2020. My expectation is, again, first rate cuts to 0 towards the end of the year, potentially alongside the headlines of re-engaging a trade war with China, and then moving into real QE. And once we get to 0 interest rates twice, that's very similar to what we saw in the 50s and 60s, which eventually led to runaway inflation. And it caused interest rates at the federal fund rate to go all the way to 20% with Paul Volcker. And what's important is that when you have inflation, you have decades of negative returns in stocks and bonds, which is what most investors are not ready for. Our members certainly understand why this will happen, how it will happen, and how to profit from it. So if you think this next crash might just be a little one and we rebound for eternity to higher and higher levels, just remember that this chart will most likely repeat itself just like it did in the 50s and 60s. You spend too much money it escapes out of these bubbles, you get inflation. And the Fed has a simple strategy for dealing with inflation. You can see the blue line is inflation. Every time it perks up, the Fed hikes interest rates. Every time we hike interest rates, that makes the cost of money and debt expensive. And that's the very rare times in the last 100 years that we have negative GDP prints, which means stock crash and a bond crash. And so you can see that's the big fear you should be concerned about. And if we can predict what the Fed's going to do with rates, this also helps us predict the bond market. All right, I think we've given them enough info for today, Dean. If you do join us Monday, I might have time to do the second half of the presentation where we do look at inflation in the markets. So I'll just end here with call Dean now to get a discount and to get into our boot camp. If you do like the material you learned today, this is just the tip of the iceberg. So I'll go ahead and put it back on your screen now, Dean.
Okay, sounds good. Thank you, Jason. And give me just 1 second here. We'll get that started. All right. Okay.
Okay, so let's see. I think you are the host now, but I think you still have to share your screen.
Yeah. Okay, cool. All right, folks. Well, thank you very much. And thank you, Jason. That was a really good amount of detail in a very short period of time. Just real quick, does anyone have any additional questions? I know we covered a ton in the financial system, couple outlooks we have moving into the next few years. Anyone have any questions at all? Please feel free to unmute your microphone, type them into the chat box. Scotty, I see your microphone is unmuted. Do you have a question, bud? Okay, looks like Scotty's good. Anyone else out there have any questions? Okay, it doesn't look like it. So I'm going to go through a couple more things that we do here, folks. And like I said earlier, really the whole methodology of what we provide as a service to our clients is to help you to, number one, never lose your money, and number two, never forget rule number one. Okay, yes, we will help you slowly grow it, but capital preservation is absolutely key, and not losing your hard-earned nest egg is really key to investing. So I'm going to go over under bullet point number 4 here. I'm going to go over a few things. So we offer a handful of different services for our clients. Okay, so for our service, I'm going to talk about our commitments to providing unmatched service. And with our service, we're going to actually hand you the fish. So Jason and I are going to look at the market constantly, so you don't have to look at the financial system, the macro environment, and the news flow to engineer our trade alerts, send them out to you at noon Eastern Standard Time, and you simply replicate them with your account. Okay, you're going to have access to the daily live presentation. There's not another service on the planet that's going to offer daily communication verbally via webinars. It's not out there. It does not exist. It's just not something that's out there, period. And so we absolutely love to show off that difference and the level of commitment that we have to our client base. Number two, we also have a boot camp. Okay, and in the boot camp, Jason's going to really teach you how the financial system works and why it's the best decision to be defensive with your investments. Okay, and inside of the boot camp, we're going to teach you how to fish so you can become a pro. Okay, and it's a whole different level of education. There's going to be more content. Hours and hours more content to consume each week. We actually do a Q&A session every Monday, quiz you on it, and then on Tuesdays we do our presentations and really kind of the core of the educational process there. And I want to remind everyone as well, you do get a free investment consultation with me, Dean Gallagher, and you can call me at any time at 505-322-7515. And we can either, depending on my schedule and yours, we can either do that live, or potentially go over that with you. What at a later date, whatever will work best for you. Okay, and number 5, the bonus for the clients that sign up today. I do have a really neat package where if you combine both the service and the boot camp, you'll get a 40% discount. And actually, if you're just willing to submit a video testimonial to me and send that to me in an email that you're willing to make that commitment to me 90 days after the day you sign up, I'll actually remove 40% off either the service or the boot camp today to get started with us. So definitely feel free to call me to get that locked in. And like I said, if you're willing to make a commitment for a video testimonial for us 90 days after you start, I'd be willing to offer you a nice $2,000 discount to get started. And all you have to do is call me at 505-322-7515. And if you want to take advantage of both the service and the boot camp too, we do have a very nice discount at 40% for that as well. Okay, moving on here. I'm going to go to my next slide. The things that you're going to need to get the most out of our service: a brokerage account. Obviously, you're going to need to replicate the trade engineering we're sending out. Number 2, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts released daily at noon. Okay, by no means are they time sensitive at all. They just simply need to be placed before the market closes at 4 p.m. daily. Okay, and so you have a 4-hour window from noon Eastern to 4 Eastern to place those trades. You're going to need a mobile phone to receive our text message trade alerts. Many of our clients take these trades on the go from the airport, restaurants, in the car, anywhere you have service. If for some reason you're not getting the text message alerts, email Ryan at portfoliobuilder.io immediately. Send him your cell phone number and he will add you to that list. You will need an email provider that's in good working order. That way you can access our daily webinar invites via email, and we also send out our trade alerts via email on top of text messages. Okay, and I saw I had a question hit here, so give me 1 second while I change over to that screen, and we will see what the question was. So let me see what came in here. Okay, and it looks like, okay, how much is the boot camp and how much is the cost of the service? So there's a couple options, and I'm not sure what your name is because it says email guest, but if you want to go ahead and unmute your microphone, please feel free. So there's multiple options as far as pricing for the boot camp goes. We do have a lifetime option that's available, and we do have a annual option that's available. And as far as the service, we have the same as well. And if you combo both, you're going to get the biggest discount. Okay. And like I said, in the boot camp, we're going to teach you how to fish, when to fish, and why. We're going to teach you how to tie the flies, everything. Okay. And as far as the service goes, we're really going to hand you the fish on the silver platter. You replicate, the trades we've engineered, and you're going to get access to a daily video every single day, or daily webinar every single day that you can interact with us. But if you want to take that to a whole nother level, absolutely feel free and do so. And a lot of our clients typically start with the service in general, but a week or 2 weeks later, they'll add the boot camp on top of it just because they want to get even more in depth of what we're doing. And really, they realize that this works, it's profitable, it's insanely safe. And so they want to put a lot of money behind it. So, they want to learn more about the system. And those are the type of people that end up putting in $500,000 to a couple $1 million within the system. And once again, call me at 505-322-7515. We can talk about all the options that are available to you as a client. Okay. And so these are a couple things that you're going to get during your trial. Okay. Trade alerts daily. We already went over that. It's pretty simple. We trade the SPY Monday, Wednesday, Friday. Not next Wednesday though, because we're going to have New Year's Day. We trade EM on a 10% allocation on Tuesdays. We trade TLT at a 40% allocation and GDX at a 10% allocation on Thursdays. That's what we consider our risk-off plays, folks. Daily live presentations with a live chat to ask questions. Those are going to start at about 12:05 Eastern Standard, Monday through Friday each day. You can access the live presentation from the email we send out each day. Simply click on the image that looks like a YouTube video. Please ask any question to Jason, myself, or Victor during the live presentation. And Victor wasn't on this live presentation, guys, but he is your dedicated support specialist once you do become a customer with us. He's going to give you his cell phone number and just provide absolute white glove customer service. Okay, and live Q&A opportunities. The sessions will run for 1 to 2 hours every day, guys. Please feel free to take advantage of that. The more interactive our presentations are, the better understanding you're going to have, the higher level of comfort you're going to have with us, and the more value you're going to get out of our service that we deliver. Okay. Unlike any other services out there, we connect with our clients on a daily basis to ensure superior communication and white glove customer service. It's just not something that's available in this ecosystem, period. I talk to clients all the time that have money managers that are charging them, anywhere from 1% to 2%, with $500,000. So these guys are paying, $5,000 to $7,500 a year, and don't ever hear from them. Don't get any education from them, besides some pamphlet that's, sent out by, whether it's Schwab or, whoever, but it's not tailored content to them by any means, shape, or form. We're not talking, they're not talking about their positions, and they don't have the ability to do it on a daily basis. It's crazy that that's not available to the people in the financial system. But that's part of why we love offering what we do to our clients. Okay, moving on here. If you are on a free trial, make sure to utilize $300,000 for your replication, either on paper or real capital. Okay, that way you can pay for the cost of your service before it's even over. Okay, and like I said, 30% of our client base that are existing clients now follow those instructions and were able to, pay. They had more in profits than we had as a service fee. So I mean, how else do you enter a win-win situation? And it's just a great way for us to develop a phenomenal amount of trust with our clients, before we ever ask them for a single dollar. So if you're following this on a trial, please feel free to utilize $300,000, whether that's going to be in real capital or paper trading capital. Okay. And once again, my name is Dean. You can always feel free to call me with any questions. Okay. My phone number is right down here. Definitely save it in your cell phone, write it down, and tape it to your computer. It's 505-322-7515. And yeah, folks, I think that covers it for today. Definitely look forward to learning more about your investment ecosystem. What's been working for you, what's not working for you. See where you're underinvested, see where you're overinvested, and just see how we can help out with your financial ecosystem. And as I said, it's a great added value during your trial. So please feel free to give me a call to review that. 505-322-7515. And Jason, I'll go ahead and let you close it out there, bud. Any last remarks? Any last questions or comments from anyone in the audience today as well?
Appreciate the content. Really good.
Hey there, Scotty.
Awesome. Thanks, Scotty. Appreciate it. Ronald, I see you said thanks. You said thanks. And then is this Redor? I'm sorry, YouTube guest. Can you repeat your comment or question though? Okay, so email guest said, thank you very much from Joe. Joe, thank you for your time to join us today. We absolutely, truly appreciate it. And please feel free, Joe, to reach out to do your free investment consultation at 505-322-7515. All right, any other questions, comments out there, folks? Sounds good, Joe. Look forward to it. Oh, yes, YouTube guest, this will be recorded. If you want to go ahead and just click on your email, about 30 minutes from now, you can click on the same image, okay, that took you to the presentation today. And what it's going to do is it's going to send you a redirect link to YouTube, and you will see the recorded version on there as well. And you can always go to Portfolio Builder Just type in Portfolio Builder as one word and YouTube in a Google search. Go to our channel and subscribe to it. That way you will always get our content delivered to you too. It'll be highly delayed, right? If you're not on a trial, if you're not a client, it'll be highly delayed, but that way you can always follow it as well. Okay, awesome. And Joe, thanks for sending over that email there. I appreciate it. We'll definitely be sure to save that, and I will send you the email or the recorded version as soon as I have it as well. So I'm going to go ahead and save your email real quick while I'm running through this. And